So we are now 1 month into 2024. I cannot believe it. I don't know about you, but I've been doing some buying in the stock market, even as things are hitting record highs. We're going to get into some of the stocks that Tyler and I have bought so far this year. Before we do, take a minute, click subscribe to my channel, and please take a look at the link you see on your screen. You can get the top 10 stocks to buy right now from the Motley Fool, and it's the best way to support this work we're doing on YouTube. So I'll talk briefly about one stock that I bought this year that'll be a familiar favorite, and then Tyler's going to talk about something that's a little bit of a unique situation. Um, so I bought shares of SoFi this month. Surprise, surprise! One of my favorite kind of growth stocks to look at. I'm a big bank stock investor. SoFi is not my biggest bank stock, not even close. I, 80% of my bank investments are in Bank of America and Wells Fargo. Much more of a value player, but I like them as kind of an up and coming. I think of them almost as like a hedge on what if fintech gets it right finally, because they have the most traction of any of the major fintechs that I know of. The fourth quarter numbers were impressive, and even if Tyler's not on Team SoFi, you'd like some of these numbers that are starting to make it look more like a bank. They achieved GAAP profitability for the first time and are expecting to do so consistently going forward. They're making most of their money by taking in deposits and loaning out money now. They just became a bank 2 years ago, and pretty much started from zero on the deposit side, and now have almost enough to cover their entire loan portfolio. So they're starting to look more like a bank than they were before. All three of their business segments, lending, their technology platform, and financial services, are all producing positive contribution profits to the numbers I mentioned. And the member growth is just phenomenal. I don't know of any other bank growing its membership base or its customer base at 44% year over year, even at this size. Net interest income is up significantly, which most banks it's falling right now because just deposit costs are outweighing the gains they're making on loans. Not the case here. SoFi's net interest margin is just over 6%, which is roughly double what Bank of America and Wells Fargo are putting out. There's a lot to like about this one right now. It's not without risk. I will be the first to admit that. This is by far the riskiest of my three bank stocks. If the economy goes south, I could see this getting a lot more affected than either of the other two. The personal loan default rate is a big cause for concern for me right now. A personal loan default rate of 4.8% is more than most credit card companies are producing. So that's saying their credit quality might not be that great right now. In my opinion, that's one of the big reasons for the negative turn in the stock after the initial earnings pop. So all in all, I think SoFi is looking good. Their outlook is nice, but even I'm a little skeptical on it, if I'm being honest. They did say they'll be GAAP profitable going forward. I'm not skeptical at that part. I'm skeptical where they say that by 2026 their EPS will be between 55 and 80 cents a share. That means they're trading at roughly 10 times 2026 earnings with a 44% growth rate. If they can do that, this is going to be a big winner. I like the stock long term. I like that management has a great history of just beating their own expectations so far. There's a lot of question marks still in the air, but so far they're producing results. But watch that default rate. Tyler, you're watching one that is a business that's not really a business yet, right?
Well, it was a business, and then it decided to shift gears, and it's kind of been in a holding pattern for quite some time. This is very much a special situation, if you will. And so what I recently bought, and I bought this for a managed account for somebody else that for whom I manage a small account for them. But I picked up Equity Commonwealth. Equity Commonwealth, by its market designation, is an office REIT, which sounds like the craziest thing to do right now in when we hear like office vacancies all over, just not good. It's really a misnomer because Equity Commonwealth is not an office REIT. It is a pile of cash with a couple of offices attached to it. As of right now, Equity Commonwealth has a 2,030,000,000 market cap. It has zero debt and has $2.12 billion worth of cash just sitting on the books. So there's more cash just kind of sitting around in this thing than what the market actually says it is. So it's currently trading for less than the value of its cash on its books. Now, this is a unique situation. I don't know how many people are familiar with Benjamin Graham and the Intelligent Investor, but he does a whole chapter on a unique situation called net stocks. A net stock is basically where the net current assets of the business is worth more than the liabilities and the market cap combined. And basically, it's the biggest margin of safety you can possibly ask for in the market at any given moment. And right now, Equity Commonwealth is valued as a net stock. It's basically saying that the office portfolios that it has are going to earn $0 and that its cash is worth less than, what it says it is. With interest rates at 5% today, I mean, you're already generating 5% on that pile of cash. So there is some value there. And Equity Commonwealth is sitting on this cash because it liquidated all of its office portfolio many years ago and has been waiting for an opportunity to transition to other real estate. Right now, we're starting to see commercial real estate default rates tick up. I just read a Calculated Risk Real Estate blog by Bill McBride. It's a very good kind of daily news report on everything real estate, and they noted that the default rate on commercial real estate is the highest it's been since the Great Recession. And so there is a possibility here that there's going to be a lot of very, very cheap assets potentially in foreclosure, where Equity Commonwealth is just going to have this pile of cash ready to go to buy things for pennies on the dollar. And so with a business right now that's generating cash because it gets interest, it has that small office portfolio, and then a huge option to come in to a distressed market and buy things super, super cheap. It looks like an incredibly valuable position to be for now, the next several years, and hopefully beyond that, because if you can pick up super cheap distressed real estate right now, several years from now, it's going to look like an incredible deal.
So I just want to ask two follow-up questions with that. Number one, you mentioned that they have a little more cash than their current market cap. I assume that it's not actually just sitting in just a cash account. It's invested like in treasuries or something that produces some kind of yield. If you know that or not, but I'm assuming that that's the case. And number two,
So
so what would
yeah,
you say the biggest risk is, that they don't find anything to do with their money?
I would say yeah. So it's as of the over the past 12 months, it's generated about $100 million in interest income on its pile of cash. So that's what, 5%? So yeah, basically like money market accounts that we all kind of are sitting on, our short-term treasuries. So, there you go. That it's some sort of cash coming in the door to cover anything. And yeah, that is a risk that, this they could not find anything, but I, look, regardless of like the prevailing tailwinds of the broad commercial real estate, there's always somebody doing something stupid in commercial real estate. And if somebody's doing something stupid right now, there's a good chance that they could be distressed and need somebody to inject some capital. And that is where I think Equity Commonwealth is going to be well positioned. They are an entity of the now departed Sam Zell, and he was famous for during the Great Recession playing this exact playbook, like being very cash heavy and ready to buy things when the market went south. And I think that his, you know, the people who followed him in Equity Commonwealth have kind of taken that to heart and are going to probably run that playbook again.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.